So the last topic of inheritance tax is overseas aspects of inheritance tax. So what is overseas IHT? Mean how to pay the IHT on your overseas assets. So there are two rules, first 2 points. If a person is UK domiciled, domicile in short, you can say domicile mean you have a nationality of UK. So domicile mean nationality, UK nationality holder. So if you are UK domicile, then you have to pay UK IHT on worldwide assets. And second point, if a person is a non-UK domiciled, just like us, we are non-UK domiciled, then he has to pay UK IHT on UK assets only. So these 2 points are very important. If you are UK domicile, then worldwide assets, you have to pay IHT, UK IHT on worldwide assets. And if you are non-UK domicile, then only you have to pay UK IHT on UK assets. Now, what is UK domiciled? Domicile definition. I am sending you a page on WhatsApp. The domicile definition is given on the page. If you can see overseas aspects of IHT, domicile and deemed domicile definition. So from the WhatsApp page, you can see I am reading domicile and deemed domicile definition. The definition of domicile for IHT is the same as for income tax and capital gain tax. Income tax and CGT overseas aspects, I will tell you later on. There is a separate topic. So in overseas income tax and overseas CGT topic, the same definition which you will use for domicile here in IHT overseas, I expect same definition of domicile you have to use. The second point, however, with effect from 6 April 2017, there are three situations in which a non-UK domiciled individual can be deemed to be UK domiciled for IHT purpose. I mean, after 2017, there are three situations in which you will be considered as deemed domicile for IHT purpose. Deemed mean you are not domicile, but you have to assume you are UK domicile. In which three situations you will assume that you are deemed domicile assumed? So first heading is first situation is heading UK domicile individual leaving the UK. Here it is mentioned an individual who has been domiciled in the UK, comma, and now moves abroad and makes another country his or her permanent home, retain his or her UK domicile for 3 years. Means, for example, here you are UK domiciled, and in this date you are leaving UK, leaves. So when you left, but for coming 3 years, you will be deemed for 3 years. You will be considered as deemed domicile of UK. However, you left, but you will consider as you are deemed domicile of UK for coming 3 years. So this is the first situation. Now the second heading. Number two situation is long-term resident. So if you are long-term resident, then you will be considered as deemed domicile. So what is the definition of long-term resident? So an individual is deemed to be UK domiciled in a tax year if he or she has been UK resident for 15 out of last previous 20 years. So for example, you are living in the UK, and when you complete 15 years of your residency in the UK, then automatically you will be considered as deemed domicile. So 15 years out of last 20 years, you are resident. Resident means you are living in the UK. So when 15 years completed of your residency, then you will be considered as deemed domicile also. And next, at least one of the previous 4 tax years ending with the tax year of the chargeable transfer. So out of last 4 previous years, in any 1 year, you will make the chargeable transfer also. Then you are considered as long-term resident. And if you are long-term resident, then you are deemed domicile of UK. And third definition of deemed domicile is formerly domiciled resident. You are formerly domiciled resident, then you are also deemed domicile of UK. And what is the definition of formerly domiciled resident? Definition is an individual is deemed domicile in the tax year if he or she was born in the UK and his has his or her domicile of origin in the UK. Domicile of origin mean your parents are also domicile of UK and is UK resident in that tax year. That tax year mean when you make the chargeable transfer. And last, and was UK resident for at least one of the two tax year immediately preceding the tax year. So when you make the chargeable transfer in previous 2 years, at least one in one tax year, you must be UK resident. If this the formally domicile resident definition is completed, then you will be considered as deemed domicile of UK. So from WhatsApp list, this page you can see the definition of deemed domicile for IHT purpose, and in these three situations you are considered as deemed domicile. So these definitions you have to remember. Now see in the notes, domicile by birth, domicile by dependency, domicile by choice, and deemed domicile status for IST purpose. There is no need to read these because the WhatsApp page you have to read. Now this definition is complete. Now the next is how to determine the location of assets. Mean how you will determine your assets, in which country your asset is located. So there are there are two columns in the box. First, if you have land and building, then next physically located. Obviously, if it is physically located in any country, that is considered as that country's asset. Chattels physically located, you have to see and then decide in which country it is located, then you will consider this asset that country's asset. Bank account location of branch mean you have to decide from the location of branch and then decide that country's asset. Bank account, sorry. And shares and securities registration place of company. So you have to check the registration place of company and then decide in which countries shares and securities will be considered. And debtors see the location and then decide. Now next, double taxation relief DTR. If double taxation relief DTR is available, tax is charged, sorry, if double tax is charged, then DTR available at lower of number one, UK tax on that asset, and number two, overseas tax on that asset. Choose the lower of, and that will be your DTR. And DTR is only available to UK domicile. Why only UK domicile person will receive the DTR? Obviously, because he will face the double tax. UK domicile person, the rule is UK domicile person is paying the UK IST on worldwide assets. That's why he will get the DTR relief. So you can write down an example on DTR, a short example. For example, question is a person has an overseas asset worth 200,000. Now he paid overseas tax of 12,000 on it. He died in 2020 and he has no unused NRV. Nil red band is no unused NRV. All nil red band is consumed, and he is He is UK domiciled. Now your requirement is calculate the UK IHT on the overseas asset of his overseas asset. And this person is died, so overseas, how to pay the UK IHT on this overseas asset? Overseas asset worth is 200,000, and nil rate band is already consumed, so apply the 40% death tax rate. So what is IHT? 80,000, and this IHT will be reduced by the DTR relief. Why? Because on this asset you are paying overseas tax and now in UK IHT. So our DTR is lower off. Number one, UK IHT on that asset. You are paying 80,000 IHT on this asset in UK. And number two, overseas tax on that asset. You paid 12,000 overseas tax. Choose the lower of 12,000. It will become your DTR relief deducted from 80,000. And what is the IHT payable? IHT payable is 68,000. So that's how you will pay the IHT on overseas asset. Okay, next. Transaction cost on overseas asset. If transaction cost is incurred on disposing an overseas asset, then that expense is an allowed expense at lower of two things: actual expense and 5% of value of asset. So on overseas asset, if you paid the transaction cost, it is allowed expense and reduce the value of asset. Please write down a question on it. For example, Mr. A inherited an overseas asset on which transaction cost of 2700 was paid and IHT of 32,000 was paid in overseas. Next, IHT, sorry, in overseas. And now next, overseas asset worth is overseas asset worth is 300,000, and UK, now requirement is calculate the UK tax on this asset. So assume your nil rate band NRB is used, already consumed. So how to pay the UK IHT on this overseas asset. What is the value of asset? 300,000 less transaction cost, and it is lower of number one, actual expense 2700, and number two, 5% of value of asset 300,000 is equal to 15,000, lower of 2700. So this is your transaction cost, allowed expense. And what is the remaining value of asset? 297,300. Now your nil rate band is already used, so on 297,300 apply the 40% debt tax. So IHT 118,920. So this IHT is reduced by the double taxation relief DTR available at lower of number one, UK tax on that asset. In UK you paid 118,920 tax, and number two, overseas tax on that asset, and in overseas you paid 32,000 tax on that asset. So choose the lower of 32,000, deduct, and what is your remaining IHT payable is 83720. So that's how you will pay the IHT on overseas asset. This is the whole procedure. So that is the overseas IHT topic complete. That's it. One last topic, if you remember the benefits of lifetime gifts, one of the benefit of lifetime gift is if the value of asset uh, decrease, if PET and CLT value, lifetime gifts value decrease at the time of death, then fall in value relief available. So fall in value relief is if value of asset falls after making lifetime give mean patent CLT, then fall in value relief available for death tax purpose. And formula is fall in value is equal to market value at gift date minus market value at death date. So please write down a question on it. So through question I will tell you the whole concept. So question on fall in value relief is Mr. A made following gifts in February 04 gift to son worth 200,000 and in May 07 gift to trust worth 350,000. Now next paragraph, Mr. A died in June 2009 when value of asset gifted to son was 160,000. So it means in lifetime 200,000 value of pet and at the time of death it become 160. So at the time of death value decreases. So on this pet fall in value relief available. And next and asset value of asset gifted to trust 400,000. So pet CLT value 3,50,000 in lifetime and at the time of death value increases. So it doesn't matter, it will not affect you. You have to use the lifetime value at the time of death. If value increases, it doesn't affect the taxpayer. But if the value decreases at the time of death, fall in value relief available. So now how to pay the tax? So firstly, lifetime tax we will calculate on these lifetime gifts. So first gift, February 04, first gift. It is a gift to son, February 04, tax year 0304. So what is the value of transfer? 200,000. Less annual exemption of current year 0304 3000 and 0203 previous years 3000 deduct. So the value of pet is 194,000 and on pet there is no lifetime tax, IHT exempt. Now the second gift is May 07 gift to trust CLT and tax year 0708. So what is the value of transfer? 350,000 less annual exemption of current year 0708 3000 and 0607 3000. So what is the value of CLT? 344,000. Now check the on lifetime tax is paid on CLT. So firstly check the NRB on 0708 on gift year. From this 708 you will see from the IHT nil rate band table which will be given in exam, and 300,000 nil rate band available for this tax year. Less last 7 years chargeable transfer. And always from gift date go back 7 year, and gift date is 0708. When you go back 7 years, pet is available, and pet is not chargeable, it is exempt in lifetime, so nothing. So available NRB is full, 300,000. Now pay the tax on 344,000 value of CLT, out of which 300,000 cover in the nil rate band, zero tax is equal to zero. And the remaining 44,000 at the rate of 20%, because lifetime tax, if examiner is silent, assume lifetime tax is paid by donee. And if donee pay, then 20% rate. So 8,800 is the tax on CLT. Now he died, and when one person died, he died when he died, for example, in this question he died in death date in 2009 June. So from death date, always make at the time of death. Now calculate the death tax. On which gifts you have to pay the death tax? You have to check the death date is June 09, and first gift in February 04, pet, and value of pet is 194,000. Always make the timeline at the time of death always, because it's very important. May 07 CLT next, and value is 344,000, and he died, so that date is June. So from that date go back 7 year and check whether all these two are within 7 years of death. So in this question, yes, these two are within 7 year of death date. So on these two gifts you have to calculate the death tax. So first on pet calculate the death tax. So February 04, pet 194,000 value. So same from timeline, I just making a heading. And at the time of death, pet value decrease. So on this pet, fall in value relief available. And the formula of fall in value is market value at gift date 200,000 minus market value at death date for 1,60,000. So fall in value relief 40,000. Deduct it, and what is the pet value now after fall in value relief? 154,000. And now on this value pay the death tax. So firstly check the NRB availability at death year, because you are calculating the death tax. Death year is 0910. So 325,000 nil rate band available, less last 7 years chargeable transfer. And from gift date, and you make this pet in you make this pet in February 4. So go to the timeline, and from February 4 go back 7 year, and there is no, from pet date go back 7 year, there is no chargeable transfer. So available NRB is 325,000. So on 154,000 pet, all value cover in this nil rate band, 0% tax is equal to 0 IHT. Maybe tax is zero, but PAT become chargeable at death. You are applying the rate, tax rate, so it is chargeable now at the time of death, because PAT is within 7 year of death. So chargeable transfer mean on which these tax rates, applying the tax rates, you make the, you apply the tax rates. So the chargeable, that become chargeable transfer. The gift become chargeable on which you make this step. So this is chargeable transfer. Now second, from timeline just pick the CLT May 07 CLT value is 344,000. Now pay the death tax on this value, because the value of CLT increases. So it doesn't affect you. You will pay the death tax on the lifetime value of 344,000 from timeline. So firstly check the NRB at death year 0910. 325,000 less last 7 years chargeable transfer. And from gift date, obviously you make this CLT May 07. So this is gift date. So from timeline from May 07, go back 7 year, and you can see pet You can see within 7 years. So pet become chargeable at death. So it become chargeable now. And which value you can deduct, it is very important point. If you see before, from the timeline, 194 value you have to deduct from here. Means before fall in value relief value you have to deduct from here, not after fall in value relief. So please remember this point, it's very important. So that's why timeline is important, because from timeline the value you have to deduct, not after fall in value. So available NRV is 131,000. Now pay the tax on 344,000 value. So up till 131,000 zero tax is equal to 0. And the remaining 213,000 at the rate of 40% tax, 85,200. And this tax is reduced by the taper relief. Taper relief. And this gift and death date, uh, the gap between gift and death date is within 2 to 3 years. So 0% taper relief is equal to 0. 85,200 into 0%. Always take the percentage of this amount, 85,200, and less already paid tax. How much already in lifetime you paid on this CLT tax? 8,800. So what is the IST payable at the time of death? 76,400. So that's it. That is the concept of fall in value relief. So topic is complete, IHT complete.